All right, welcome everyone. Let's get right into today's Masterclass Explainer. I am absolutely thrilled to have you all here as we embark on a really comprehensive journey through Chapter 5, Accounting for Liabilities. For today's session, we are adopting a strict professional mindset. We're going to completely unpack the business liabilities framework under Circular 99-2025 alongside key Vietnam accounting standards, specifically VAS 16 and VAS 18. So, prepare yourselves. We're going to look way past simple journal entries and really dig into the legal and economic realities of corporate debt. Let's get started.
Okay, before we even touch the numbers, I want to make something crystal clear. What we're covering today, it's not just abstract textbook theory. No way. This is the exact, everyday reality of what you'll be doing as accounting professionals managing real corporate debt. You're going to be making decisions that directly impact balance sheets, regulatory compliance, and actual cash flows. Everything we discussed today has an immediate, highly practical application in the real business world.
So, here is our roadmap for the day. We're going to start by establishing the framework and principles in Section 1. From there, we'll break down the major liability accounts one by one. We'll go through trade payables, move on to borrowings, tackle state taxes, and finally, we'll wrap the whole thing up with payroll and deductions. Right, let's jump straight into Section 1, Framework and General Principles. Before we even think about touching a debit or a credit, you've got to understand that all of our accounting entries rest on a very solid legal foundation. We're talking Circular 99-2025, the borrowing cost rules in VAS 16, and the provisions on contingencies in VAS 18. Now, I need you to pay very close attention here. There are 3 absolute non-negotiable conditions you have to satisfy to officially recognize a liability on the balance sheet. Number 1, there must be a present obligation resulting from a past event. Number 2, there has to be an expected outflow of economic benefits. Essentially, money or assets have to be leaving the company. And number 3, you must have a reliable measurement of that value. If you miss even one of these strict conditions, it completely changes how we report the debt.
Let's test that out with a real-world scenario. Imagine your company gets sued by a client for 5 billion VND. Massive lawsuit, right? But your legal counsel advises you that there's only a 40% chance of actually losing the case. So, how do you handle this? I'll give you a second to think about it. Well, because the probability of an outflow is under 50%, we absolutely do not recognize this as a definitive liability on the balance sheet. Actually, under VAS 18, this is classified as a contingent liability. It doesn't get a journal entry at all. Instead, it goes strictly into the footnotes of your financial statements.
Moving right along, let's get into Section 2, Trade Payables, which is mapped to Account 331. Account 331 is honestly the heartbeat of a company's daily external operations. It's tracking the debts we owe to our suppliers. Let's map out exactly how this works when you throw foreign currency into the mix, using the Vina Food import case as an example. In June 2025, they import inventory worth $800,000 US. Based on the exchange rate at the time, which is 25,100, we debit inventory and credit trade payables for 20 billion, 80 million VND. But watch what happens in August when it's actually time to pay the bill. The exchange rate has climbed to 25,400. To clear that exact same 20 billion, 80 million VND payable, they actually have to send 20 billion, 320 million VND from the bank. That exchange rate fluctuation, it just created a 240 million VND deficit. Under Circular 99/2025, that difference is booked directly as a financial expense, specifically an FX loss, in Account 635. Notice that it does not change the original value of the inventory we recorded.
While we're still on the topic of purchasing, I want to warn you about a very common trap, both on exams and in real-world practice. Do not confuse a financial discount with a commercial discount. They are fundamentally different things. A financial discount is a reward for paying your bill early. We treat this as financial income in Account 515. A commercial discount, on the flip side, is a reward for buying in bulk. This directly reduces the purchase price of the goods, which means it physically lowers the inventory value itself. You've got to memorize these distinct journal entries. It's absolutely crucial.
Let's transition over to Section 3, Borrowings, which we track in Account 3041.
Look, when short-term trade credit from your suppliers just isn't enough to fund operations or expansion, companies inevitably turn to banks for formal loans. And when you sit down to record these loans, classification is literally everything. We have to separate short-term from long-term debt. Short-term is due within 12 months, and long-term is due after 12 months. Simple enough, right? But here is the crucial academic point that trips people up. The 12-month countdown begins at the end of the accounting period, the reporting date. It absolutely does not begin on the date the contract was signed. You have to analyze the remaining time to maturity at the exact moment you are preparing the balance sheet.
Okay, let's talk about the cost of holding that debt. Interest. Normally, interest is just a standard financial expense, logged right into account 635. But under Vietnam Accounting Standard 16, if 3 very specific conditions are met, we actually have to capitalize that interest. First, the asset being built requires a substantial period to complete. Second, the borrowing costs are directly attributable to that specific asset. And third, it will surely generate future economic benefits. If all 3 of these are true, the interest is absolutely not expensed, it's capitalized. That means it gets added directly to the value of the asset you're constructing. It's a real game changer for the balance sheet.
Let's look at a slightly more complex scenario to test this out. Suppose your company borrows 3 billion VND. You use 2 billion of that to invest in a subsidiary, and you use the remaining 1 billion to build a brand new warehouse. How do we handle the loan fees and the interest? Well, you actually have to split the costs based on the economic substance of the transaction. Investing in a subsidiary, that does not meet the VAS 16 criteria, so the interest on that 2 billion is expensed immediately to account 635. However, the 1 billion used to build the warehouse absolutely does qualify, so the interest on that specific portion is capitalized into the asset's overall value.
All right, let's shift gears entirely and dive into Section 4, State Taxes, categorized under Account 333. Now, I have to warn you, Account 333 isn't just one simple account. It's more like a complex web of 9 different sub-accounts, and each one deals with a different governmental obligation. Navigating this requires extreme precision. To make sense of it all, we first have to divide taxes into 2 main buckets, direct and indirect. Direct taxes, like corporate income tax, are levied directly on the company's profits. Indirect taxes, like value-added tax or excise tax, are completely different animals. So the absolutely crucial point here is that indirect taxes are not corporate expenses. They are simply money your company collects from the customer and essentially holds in trust for the government. Because of this, indirect taxes must be entirely excluded from your pure revenue figures on the financial statements. Let's take this slowly and look at exactly how these indirect taxes stack up on top of each other. We'll use the Beer Saigon case to illustrate. The base revenue for 10,000 bottles of beer is 150 million BND. But because beer is a special good subject to extra duties, we first have to calculate a massive 65% excise tax on that base. That comes out to 97.5 million. We add those 2 together to get our new subtotal of 247.5 million. Then, and only then, we apply the standard 10% VAT on that new subtotal, which adds another 24.75 million. So the total cash you physically collect from the customer is 272.25 million. But remember, only 150 million of that whole shebang is actual recognized revenue for the company. Beyond just VAT and excise, there's a handful of other key sub-accounts you really need to memorize. For instance, account 3334 for corporate income tax, which, by the way, now includes considerations for the 15% Pillar 2 global minimum tax. Then we have account 3335 for personal income tax. Here, the company has a strict legal duty to act as a withholding agent, meaning you are the one deducting the tax before you even pay the employee. Don't forget account 3333 for import duties, which, unlike VAT, are actually added directly to the cost of the imported asset. And finally, account 33381 for environmental protection tax, which is levied on specific environmentally harmful goods like coal and plastic.
And that leads us perfectly into our final topic, Section 5, Payroll and Deductions, which is covered heavily by accounts 334 and 338.
Now, these accounts deal with the financial obligations related to what is arguably the most important asset of any business, its people. I want you to think about a very specific number, 5,310,000 VND. Under Decree 293/2025, this is the absolute minimum wage floor for Region I. As an accountant, you are the ultimate compliance gatekeeper for the company. Paying even a probationary worker below the legally mandated percentage basis of this floor violates the law outright. You have to ensure the payroll system is fundamentally 100% compliant from day one.
On top of that base salary, there are some pretty heavy mandatory deductions that total up to 34% of the salary base. And it's really important to understand how this financial burden is split for the major insurances. I really want to emphasize the distinction here. For social insurance, which totals 25.5%, the employer pays the bulk of it at 17.5%, while the employee pays 8%.
For health insurance totaling 4.5%, the employer chips in 3%, and the employee contributes the remaining 1.5%. We also have to account for unemployment insurance at 2%, which is just split right down the middle, 1% from the employer, 1% from the employee. But notice the trade union fee, which is also 2%. This one is uniquely borne 100% by the employer. When you total this all up, the employer is essentially paying an extra 23.5% on top of the salary base, while 10.5% is deducted directly from the employee's paycheck.
Overtime is another incredibly critical calculation you'll handle. Employees earn 150% premium on regular weekdays, 200% on weekends, and a massive 300% premium if they work on holidays. Now, all of this payroll data, the base salaries, the overtime, the complex deductions, it all has to be synthesized. The vital bridge between the HR department's raw data and our accounting general ledger is Form 08, the payroll allocation table. It ensures that every single dong is accurately routed to the correct expense account.
Okay, here's a classic scenario, and honestly, a very common exam trap, not to mention a real-world payroll headache. Let's say an employee earns a 15 million VND base salary plus a 500K phone allowance. What exactly is our base for calculating that 34% social insurance we just talked about? Is it 15 million or is it 15.5 million? The answer is just 15 million. Specific allowances that are explicitly separated in the labor contract, things like a phone allowance or a fuel allowance, are entirely excluded from the insurance calculation base. Knowing these subtle nuances, that's what separates good accountants from great ones.
So as we wrap up this masterclass explainer, I really want to leave you with this final thought. True accounting mastery isn't just about the rote memorization of debits and credits. Anyone can look those up. It's really about understanding the economic reality behind those numbers. Every single liability on the balance sheet tells a real-world legal and economic story about the company's obligations to its suppliers, to the banks, to the government, and of course to its employees. The question is, are you ready to look past the math and start reading those stories? Thank you so much for your incredible focus today, and keep analyzing those accounts.